Oh, and summarize. Okay, hey, welcome to Principles of Accounting 2. I am still your host, Dr. B. Happy to have all of you with us today uh, as we continue our journey. We are nearing the end of our journey in this course, as you know. Again, thanks so much for taking the time to join us. I am still broadcasting to you from Medellin, Colombia, in South America. I've been down here for almost 3 weeks now. It'll be 3 weeks on Monday. Um, I've been here because I'm working on a very large accounting project uh, with Latin America. And the project that we've been working on down here in Colombia is on the topic of environmental social governance, which is an accounting uh, concept. And so we've been examining the relationship between profitability and other financial metrics. You know, a lot of different ratios that you know about that you've learned through this course and the principles one. We've examined those. We've looked at all different kinds of correlations to understand the relationship between accounting and environmental social governance and company profitability. And so it's been a really fun study. We are going to be doing a couple of publications here in the near future that we're going to be submitting to some journals. And this Thursday, I'll be giving a presentation to the general public here in Medellin, Colombia, in Spanish, of course, uh, and it's on that topic. So a little nervous, but also I think it'll be a nice learning experience for myself and for them. So that's kind of where I've been at. And before we get started, I just wanted to say thank you so much for your patience over the past few weeks, and also for your efforts that you've been making in this course. It does not go unnoticed. Thank you so much for your hard work. We're not done yet, but we're close. So just to kind of show you where we are in the classroom, we are all the way down here in week 14. And so there's not much more time left. So what we're going to cover today is the final chapter for this book, basically. And related to the final chapter, we have a discussion board and we have the quiz. Now, I'm going to reiterate what I've been saying for some time now, and that is around the importance of completing all the discussion boards and the hypothesis in this course. Some students feel that it's not super important for them to do the discussion boards and the hypothesis. Now, I want to remind you that these two things combined equal 10% of your total grade. So without doing them, you are automatically not going to earn an A. The highest you'll be able to earn is a B by not doing those things. So again, I'm emphasizing the importance of doing all the work in this course. If you don't do all the work in this course, it will be difficult for you to pass. So please make sure that you're completing all hypothesis, all discussion boards, all quizzes, and of course, the LinkedIn Learning certificates. Do all those things, you'll probably be all right. If you don't, you're going to have some trouble. So just want to let you know that that's kind of how it works. That's how it's always worked. So if you're missing those things, time's ticking here. Very much time left. So just keep that in mind as we move forward. So after today's lecture, today's discussion, we'll have a very brief lecture discussion next Tuesday. That's pretty much it. So and then we'll do a review for the final as well. But I just want you to know that this is pretty much it. I mean, we're really toward the end of this course. So make sure that you get your work in. Let's go ahead and jump in on today's discussion on capital budgeting and investment analysis. Oh, sorry. So this chapter, while it is heavily invested when it comes to finance, there's a lot of accounting as well. This is, in my opinion, this is kind of like the chapter that bridges accounting and finance together. Finance and business is relatively different, but there's some similarities, and this is where really the similarities come together, is on capital budgeting and analysis. So when we talk about capital budgeting, really what we're doing is we're talking about future company investment. That's what capital budgeting is really all about. So when you hear capital budgeting, remember some time ago, we talked about the master budget. Remember that part? That was, I think, a few weeks ago. We talked about the master budget. Within the master budget, we had all those small budgets, remember? We had the sales budget that went to the production budget. Production budget helped us figure out the raw materials work in process, or I'm sorry, direct labor and overhead budgets. All those together brought us down to the cash budget, but we had those other related ones, remember? On the right side, we had the sales and administrative expense budget. And on the other side, we had that thing called the capital budget. When you hear the word capital budgeting, I want you to think about investment into the company. The company's looking to invest in itself. That's what capital budgeting is. We're looking to purchase some new equipment. We're looking to purchase a new factory. We're looking to purchase some land. We're looking to somehow invest into the company. That's what capital budgeting is. That's what an investment is. We're investing in the company by expanding. So this is all related to making decisions of whether to make an investment in the company or not, by looking at projects, by looking at the potential for purchasing some equipment or whatever. But these are the type of decisions we're faced with in business. So that it's important that we understand these things. So we're going to analyze an investment decision by looking at the point of break even. Break even, as you remember, is when do I recover my investment, right? But beyond looking at break even, we're going to look at it from a couple different ways. We're also going to figure out exactly when am I going to get paid back my initial investment. We call that the payback period. We'll look at that through a series of even and uneven cash flows. We'll look at things like the accounting rate of return, which is another way of evaluating a project. And we'll also look at net present value, which is a finance term, but it tells us how much I'm investing today, how much it's going to be worth in the future type of thing, right? Time value of money. And then we'll also look at this other thing called the internal rate of return, which tells us if I make this investment, what's my return look like internally? Okay. So these are the things we're going to talk about today. So we talked about the master budgeting process some time ago. We talked about capital budgeting being on the side of things. We set aside some money for investing in the company in the future. We call that capital budgeting. It's a process But overall, it's a process of looking at an investment decision, deciding to purchase, or in some cases sell, property, plant, and equipment to expand the business, to invest in the business, or to shrink the business in some cases. So we look at the process overall. And usually it's a 3-step process, sometimes a little longer depending on the size of the company. But usually it starts with a proposal. Manager comes to the board of directors or to the vice president, president level and says, hey, I got an idea on how to expand the company. It's like, oh, we're doing a lot of production in this area. I think we can purchase some new equipment. It'll help the company to grow even further. So the manager submits the proposal. A couple of options laid out. Machine A, machine B, machine C. You know, and what are the costs, upfront cost? How long is it going to last? All that type of information. Submits the proposal to the board of directors or to the higher level of management, and then that either gets approved or rejected. Second step gets approved or rejected by the committee, by the decision makers, and then of course if it gets approved, it goes on further for a second approval by the board of directors. So that's really the 3-step process for capital budgeting. Now, here's a couple things to keep in mind when we're looking at a capital budget. It is a difficult and risky process. The reason why it's difficult and risky is because there's a lot of factors to take into consideration. The first factor is that the outcome is not certain. There's a risk. I purchased this new piece of machinery expecting it to, we'll say, double my productivity or to reduce the amount of time it takes to produce my inventory. But will it? We don't know. It's uncertain. So it's a risk. The second thing to consider is that it takes a lot of money up front to purchase something like a piece of machinery or building, right? It's a lot of money, millions and millions of dollars oftentimes. I could have spent that money on something else. There's a risk involved here. There's a lot of money up front that we got to pay to acquire that piece of machinery or whatever. Then the third thing is it takes a lot of time. It's a long-term commitment. I can't just purchase a piece of machinery and then turn around and return it. They ain't going to take that back. All right. So there's a long-term commitment involved. And then the fourth thing is that the decision might be difficult or impossible to reverse. I purchased the machinery. I'm usually stuck with it. I can't just return it. It don't work like that. It's not like getting it from Amazon and then saying, oh, it doesn't fit, let me return it. No, it doesn't work that way when we're talking about commercial stuff. And usually there's a contract we got to sign, right? And that contract might make it difficult or impossible to reverse the decision. So these are the risks involved with capital decision making. So let's talk about those cash outflows. As I had mentioned, there's a large commitment involved here. I purchased a new piece of machinery. I got to pay that up front. There's a great chance that whoever's selling me that piece of machinery, they're not going to take that on installments. They're going to want all the money up front. Okay, so that's a big cash outflow. I got to come up with millions of dollars in cash to purchase this piece of machinery up front to acquire it. So there's a big cash outflow. Then I get the piece of machinery into my factory. I install it. Okay, I get it ready for use, and then I start using it. Now, the idea here is that that piece of machinery is going to help increase my capacity so I can make more stuff to sell, or reduce my time, which means I can sell more at a lower cost, etc. The idea here is that that piece of machinery is going to help me generate more sales. That's the whole reason why I would even invest in a new piece of asset, is that it helps me produce more sales. Okay, so I'll get cash coming in to the business from my sales. But I still have cash going out for that equipment every single year. Why? It costs money to run it. Electricity, for example, repairs and maintenance, ongoing maintenance for the machinery. These are all related expenses to the piece of machinery, right? Cost money to run it. So I got sales generated from increased production for the new machinery, and I have my expenses from using the machinery. And then at the end of the machinery's useful life, I'll probably sell it for scrap value, also known as salvage value. Or if there's a little book value left, I'll probably sell it. Or I can decide to keep using it. But that's usually the process. Think about the cash flow, cost of acquiring it, millions of dollars up front, got to pay it to the vendor of the equipment. I get the equipment into use. I'm generating sales by using it, but I'm also generating expenses. Sales coming in, expenses going out. Think about the cash, right? Think about how that operates. And then disposing it. If I dispose of the asset at the end of its useful life, I could maybe get a little something for it. It's scrap value, salvage value, whatever's left over. So that's the cash flow when it comes to an investment. Now, when I make a decision to make that investment, I want to figure out how long it's going to take me to recover my investment amount, to recover that initial investment. We call that the payback period. How long it's going to take to recover the initial investment amount. If it cost me $1 million up front, based off of the amount of sales that I project, how long is it going to take me to get that money back? Great question. So to calculate that, or figure that out, we figure out the payback period, how long it's going to take me to make that money back. And I do that with a very simple formula. I take the initial investment amount, that initial outlay of cash, divided by the annual net cash flow. Now, I want you to understand what it means for net cash flow. Net cash flow is very simple. We take the amount of cash coming into the business minus the cash going out of the business. That gives you net cash flow. Cash coming in minus cash going out gets you net cash flow. Okay. Annual net cash flow is at the end of the year, how much cash came in minus the amount of cash that went out. Annual net cash flow. It's usually an estimate, when we're making an investment decision. Now, ideally, I want this amount of time to pass to be as short as possible. Right? The shorter the payback period, the better. Now, here we have an example. And in this example, our company has what we call equal cash flows. Equal cash flows means that we have the same amount of net cash flow every single year. Maybe our company operates on a government contract, okay? And the government pays us the same amount every single year to complete this contract, right? So that's an example of equal cash flows. In other words, the net cash flow doesn't change at all. It's the same every single year. So using the payback period with equal cash flows, let's figure out how long it's going to take us to recover our initial investment. So here we have some data. The initial investment of the piece of machinery will cost us $16,000. Okay. It has a useful life of 8 years. Great. It has a salvage value of 0. So at the end of the 8 years, it's not going to be worth anything. With this new piece of machinery, I expect to be able to sell 1,000 additional units per year with a sale price of $30 per unit. Okay, great. Now we understand that. There's some cost associated with operating the piece of machinery, as you know. We got our regular costs like materials, labor, overhead. That we got the depreciation of the machinery, and we have selling, general, administrative expenses. So we got to figure out first, what is our income? And then what is our cash flows, or net cash flows? So first we figure out is sales. 1,000 units at $30 per unit. That's 30,000. We got materials, labor, and overhead expenses, 16,500. Depreciation, 2,000. Selling, general, administrative, 9,500. Sales minus our expenses gives us net income. Okay, this example, our net income is 2,000, but I'm not worried about net income. I'm worried about the cash flow. The cash. Remember, depreciation is not the same as cash. We don't actually pay cash for depreciation. Remember, depreciation is the value of the machinery, and it depreciates in value over time because it loses its useful life. As it loses its useful life over time, we consider that depreciation in value. It's not cash, not the same as cash. So that's why we see on the right side the actual cash flow. We got sales, 30,000. We actually sold 30,000 in cash. So 30,000 is the cash coming into the business, minus the cash going out of the business for operating activities. We have materials, labor, and overhead that we paid out in expenses, 16,500. We don't count depreciation in cash flow because it's not actually cash. And we also had selling, general, administrative expenses that we paid 9,500. So sales, 30,000 minus materials, labor, overhead, 16,500 minus 9,500 for selling, general, administrative expenses gives us a net cash flow of 4,000 per year. So using the payback period formula, I take the initial investment amount, 16,000, divided by annual net cash flow, 4,000, to give me a payback period of 4 years. It will take me 4 years to recover the initial investment of 16,000. That's what payback period means. How long it takes me to recover. Okay, so that's with equal cash flows, meaning that the business has the same amount of cash coming in and out of the business every single year. In reality, it's a little bit different. This might be true for like a government contracting company where they get the same from the government every single year. Yeah, that might be the case for this company. But they also might have other projects where the cash flows are not going to be equal, which is the case for most businesses. Majority of businesses have fluctuating cash flow. Cash goes up, goes down, somewhere in between every single year. That's typically how it works. Okay. So Using the same scenario, machine costs 16,000, has useful life of 8 years, salvage value is 0. Let's figure out the payback period using unequal cash flows. Now, there's a real simple way to do this. We take year 0 as being the total initial outflow for the investment in the machinery. In this example, 16,000 went out in year 0. At the end of year 1, we expect that the company will generate a net cash flow of 2,000. End of year 2, 4,000. End of year 3, 4,000. 4, 4,000. 5, 4,000, etc. And it could vary in other ways, but it's just an example. So let's take a look at graphically and kind of understand how this works. So I got minus 16,000 year 0, and I'm going to add every time my net cash flow is positive. So minus 16 plus 2 is minus 14.
Oh, so you got to look at the right side like a negative because that's the initial money.
You got it. That's exactly right. So,
Okay.
so minus 16,000 year 0. Year 1 is positive 2,000. That gives me a balance of negative 14,000.
Exactly. Okay.
Yep. Year 2, I was on positive 4,000. That gives me a negative balance of 10,000 at the end of year 2. Year 3, I got another 4,000 positive. That gives me a remaining negative balance of 6,000. Year 4, another 4,000 rolled in, gives me a remaining negative balance of 2,000. Year 5, I got another 4,000. Whoop! That brought me above 0.
Yep.
So that tells me that somewhere between years 4 and 5, I broke even. So how do we figure out exactly what month we broke even, or where typically we broke even?
Yeah, during the year.
Yeah, during the year, exactly. So the way we calculate that is we take the 4-year amount plus 2,000 divided by 4,000, which is 0.5, which means we broke even in between years 4 and 5. So 4.5 years would be the payback period in this example of unequal cash flows. It can get way more complicated than this. This example is actually pretty simple, but this is how you would calculate it. The reason why I said it could get more complicated is because the net cash flows, they probably vary a lot more. It's not going to be 4,000 for a period of 4 years. It might be like 2,000, 6,000, 1,000, blah, 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 right? So, but the overall point that I'm trying to make here is that on the cumulative side, once it hits 0, that's when you've broken even. That would mean your payback period is somewhere in between those 2 years where wherever it amounted to be 0. So that's unequal cash flows. Now, when it comes to evaluating the payback period, it's pretty easy to figure it out. It simply uses cash flows, pretty easy to compute. But where it's weak is that it ignores the cash flows after the payback period. Once I hit 0, I don't care. I'm in the positive. Great, who cares? Right? So that's kind of one of the weaknesses. And the reason why it's a weakness is because I might use that extra cash flow for another investment decision. The other thing that payback period ignores is the time value of money. What we mean here is that it's not including any kind of interest, right, that can be made. So positives and minuses about using the payback period. So that's payback period. Relatively simple. The next concept I want to talk about today is called the accounting rate of return. This is different than the internal rate of return. The accounting rate of return, basically what it tells us is how much return I would expect from this investment on an annualized basis. And we look at this as an average, okay? So it's basically like saying, hey, you know what, over the average life of this investment, this is how much return I would expect on an annualized basis, okay? So we calculate this in 2 steps. The first step is I got to figure out what is the average investment. And there's that word again, average, right? So we take average would be beginning balance plus ending balance divided by 2. In this case, we're taking the initial investment, 16,000, plus the salvage value, ending balance. This example is 0, divided by 2. Initial investment plus salvage value divided by 2. Beginning balance plus ending balance divided by 2. You see how that works? So we take, in this example, the 16,000 initial investment plus salvage value of 0 divided by 2 gives us 8,000. So 8,000 is our average investment. Now to find the accounting rate of return, step 2, is we take the annual income, net income, and our example is 2,000, divided by the average investment, 8,000, from the first step. Annual net income, in our example, is 2,000, divided by average investment that we got from the prior step. In this example is 8,000. So 2,000 divided by 8,000 is 0.25, also known as 25%. Okay, so the accounting rate of return is 25%. Whatever's highest is what we're going to go with. So if the accounting rate of return is high, based off of, I don't know, other opportunities, whatever the highest percentage is, that's the decision we make. Now, it's super easy to compute, as you just saw, which is great, but it ignores the time value of money, which means we're ignoring any type of interest, and it does not consider the cash flows or their timing, okay? It just expresses a simple percentage. It's a good tool, but it's not the only one that I would use when it comes to making an investment decision. So we talked about the payback period. We talked about the accounting rate of return. Now I want to talk about present value, net present value. As I had mentioned earlier, the net present value is a finance component, but we used the time value, net present value, which is a part of the time value of money, for us to understand an investment decision as it relates to something like interest. Okay, so what we're doing here is we're applying time value of money to future cash inflows and outflows so we can decide if the project is viable, okay, or desirable, viable, whatever. So there's a couple of steps to computing the net present value. Number 1 is I would use a financial calculator because that's the easiest way to do it. You can simply do a search online for a net present value calculator, and there's plenty of them out there. Or you can use an actual financial calculator, whatever you prefer. But if you don't have one of those, here are the steps you would take. The first step is we find the discounting of the future net cash flows from the investment at the required rate of return. That's the first step. Of required rate of return has a couple of different names. The other name is called a hurdle rate. It's just the cost of capital. It's like the interest rate, let's put it that way, okay? Required rate of return. So the first step, figure out the net cash flows at the interest rate. Okay, that's the first step. Second step is we subtract the initial amount from the investment from that. Pretty straightforward. It's a very straightforward calculation. So here's how it works in an example. This is with equal cash flows. Remember, equal cash flows means that at the net cash flows, we're going to get the same amount every single year. Unequal cash flows, different amount each year. That's the idea. So here we have an example. We're considering a $20,000 investment new piece of machinery. We have, and we expect that to provide $10,000 net cash flow each year. We have an internal rate of return of 9%, interest rate 9%. Okay. So here are the steps we would take. We have the net cash flow, which gets subtracted from the present value. So remember the steps. We find the internal rate of return, in our example 9%, and we subtract the initial amount from that. You'll notice that it says 9% at a present value of 1. This is taken from a table, okay? We call it the present value table. And so we factor it at a number of 1. The reason why we do that is because 1 is expressed as, we'll say, the whole percent, right? So 1 minus the 9% for year 1 is expressed in the table is expressed as 0.9174. It's a annuity table, right? So we take that 0.9174 minus the 10,000 gets us 9,174. And then we follow that same process each year using that annuity table. At the end of the 3 years, we add up years 1, 2, 3. We get 25,313. Guess what? That's above the initial investment of 20,000. So I take that total minus the initial investment to get a net present value of 5,313. The rule that we look at when it comes to net present value is that if the net present value amount is greater than 0, then it's a good investment. We'll do it. Now, of course, in real life, we're going to take other factors into consideration, but it's a good rule of thumb. So the decision rule is, and the process we take is we take the net present value of the net cash flows minus the initial investment to get the net present value. If that net present value is greater than 0, then we'll make the investment. If it's less than 0, we will not. We use this process to compare investment opportunities, project to project, right? That's kind of the whole idea behind it. And you can apply this. It doesn't have to be like machinery. It could just be a simple matter of selecting a project. Right? So net present value takes into consideration the annuity factor. The idea here is that we're looking at, without saying it, interest, right? So we look at the cash flow, that outflow, plus, the positive net cash flows. We get to a point where it's greater than the initial investment. which gives us the difference, which is net present value, using an annuity table. So again, going back to your simple financial calculator, you could easily figure out net present value from that. And from that, it's just a matter of plugging in the number of years, the amount, the expected return, percentage, etc. And it'll give you the net present value as a response. So that's why personally I prefer using a financial calculator when it comes to calculating net present value. It's just way easier. Okay? But I'm showing you this from this perspective because I need you to understand how it's calculated. Okay. So here we have another example of applying the annuity assumption to net present value. Company's looking to make an investment of $80,000 in new machinery. It can reduce our labor cost by $15,000 for a period of 10 years. We're going to use a 10% discount rate, and it has a $0 salvage value. So the way I would make the calculation is I got my net cash flows, 15,000. I look at the annuity table for 10 years at a 10% discount rate. Gets me 6.1446 on the table. I apply that rate to the 80,000. Gets me 92,169 minus the initial investment gives me net present value 12,169. Remember that if the net present value is above zero, then we make the investment. So this will be a good investment. Now here we have two projects side by side, and we'll try to figure out which one is going to be a better investment decision. And these have unequal cash flows. Well, technically project A has equal cash flows, project B does not. But they both have the same totals at the end of year 3. Which one will be better for us? Well, if we apply net present value using the table index, 10% return rate or discount rate, or whatever, at a value of 1, we see the differences for years 1, 2, and 3. We apply that, multiply that 5,000 times or 8,000 times the net present value amount. We get it broken out, and we can see what the total net present values would be. Obviously the totals are going to be different. And we subtract out the initial investment to get net present value. Based off of this, project B is going to be the better choice because it yields a higher net present value. This kind of shows you an example of a side-by-side comparison. Go ahead, Leland.
So I was going to ask a separate question because unlike the other tools, this one uses time value of money. So would this be the best one for a company to use over the other ones?
It's probably a little bit more accurate. Yeah. Yeah, it gives us a little bit more of closely related picture than it would be to guess when we're going to get paid back, or getting an exact payback period, or the accounting rate of return. That's good, but that's obviously just an estimate. This is a little bit more exact. It's a little bit more exact. So that's what. So the answer is yes. This would be a lot more accurate.
Okay.
A lot more accurate. Darius, go ahead.
I was just going to say, looking at the years from 1 to 3, it looks like the depreciation is the difference to me.
It does look that way, doesn't it? We typically don't take the depreciation amount into consideration because we're only looking at cash flows. As you know, with depreciation expense, that's not actually cash. It's just losing the value of the asset. So we wouldn't take depreciation into consideration with that present value. But I can see where you get that perception from, because it does kind of look that way, doesn't it? But yeah, no, we don't actually take depreciation into consideration.
Okay.
Yeah, no, that's a great observation. Very cool. All right, and then when we consider salvage value, that of course makes a difference as well. If the machinery has some salvage value, the net present value needs to be above the salvage value amount. What else can I tell you? Okay. We can also calculate what's called a profitability index. So if you have, let's say, multiple potential investment decisions you're looking at, we can calculate what's called a profitability index to give you an idea of the levels of risk. The levels of risk. It's super important for you to have an idea of how risky an investment is. The profitability index helps us to identify that level of potential risk. So the way it works is we take the present value of the net cash flows divided by the initial investment amount. That gives us a profitability index. So here we have three different projects side by side. We take the present value of net cash flows divided by the initial investment. It gives us a profitability index. Now, when it comes to profitability index, if it's less than 1, it indicates a negative net present value, which obviously indicates higher level of risk. If it's greater than 1, it's usually a good indicator that it has a lower level of risk. So in this case, I would only look at projects 1 or 2 because they both have profitability index above 1, which means they have a lower level of risk. Now, also having said that, project 2 has the highest profitability index, so I will go with project 2. Whichever project has the highest profitability index is the one that we would probably select. So that's just another way of comparing them side by side using net present value. Now, one of the last ways that I would examine a potential investment decision is through what we call the internal rate of return. As the name implies, the internal rate of return is a way for the company to say, hey, if we do this investment, this is what we would want to receive as a return. Okay, internal rate of return. I invest in a project, therefore I want to see this amount returned to me. Yeah, that's the idea of internal rate of return. The internal rate of return is looked at in a couple of different ways. It's a way of understanding the discount rate that yields a net present value above 0. Remember, we want the discount, or we want the net present value to be above 0 at all costs. If it's below 0, we don't do the investment. It has to be above 0. So we're going to calculate the internal rate of return. The first thing we got to do is figure out the present value factor for an investment project. Now, the present value factor is calculated by taking the initial investment divided by the annual net cash flows. Once we figured out the present value factor, we can figure out if that factor is going to be greater than the net present value of 0. So as long as it's above 0, we're good. So the second step here is that we need to identify the internal rate of return yielding the present value factor. So here we have an example of these two steps using equal cash flows. Step one, we got to find the present value factor. So we take the initial amount of the investment divided by annual net cash flows. That gives us a present value factor. In this example, 2.4018 is our factor. We then take that and we look at our annuity chart. And I'm looking for the 2.4018. And I find it to be 12% for a time period of 3 years. So that means that my internal rate of return is going to be 12%. Again, it's one of those, and you could do this with a financial calculator as well. As long as you have all the information that you need. That's one way of doing it, or you can use the present value of annuity charts or indexes, as they're called. When it comes to unequal cash flows for calculating the internal rate of return, it of course becomes a little bit more complex, but the way to make the decision here is that as long as the internal rate of return is above the hurdle rate, then we make the investment decision. If the internal rate of return is below the hurdle rate, we do not make the investment. So think of a hurdle rate as the lowest amount of rate of return. It's the hurdle. It's the lowest amount, right? So IRR above the hurdle rate, be good. Above that minimum allowable investment. Right? That's a way of thinking about hurdle rate. So yeah, I mean, there's good and bad about all four methods. Leland, to your earlier point, I think that net present value gives the closest real value when it comes to making this type of decision, because it considers cash flows in terms of dollars, and it reflects the actual value of money. It is difficult to compute it without a financial calculator or one of those fancy indexes, but it's probably the most accurate. The payback period is super easy, so is the accounting rate of return, but they ignore time value of money. They ignore actual cash flow. So that's why I think net present value is probably the best. Internal rate of return is good, but it ignores the changing risk over the project life. So that's why personally I prefer net present value or IRR, but really you want to compute all of them because that gives you a more holistic picture. But if you have to choose one of these four, I go with net present value, in my opinion.
I figured because it was the most complicated. That's just how it goes in life.
That's how finance works.
Yeah. If it's harder to compute, it must be more accurate.
That's right. Exactly right. Yeah. Yeah. The more values you take into the equation, the more accurate it's going to be.
Yep. Exactly.
Good point. So we can use those values when it comes to calculating the break-even time. And just as we've already seen through those earlier computations, we know that the break-even time is where the cumulative amount reaches zero. So it's the initial cash outflow for the investment, year zero, and then we add in all of the present value cash flows. When we get down to zero, that's where we've broken even. Then we can calculate where exactly that point in time was. We call that break-even time. Excel is an awesome tool to use when it comes to things like net present value, internal rate of return, accounting rate of return, uh, even figuring out unequal cash flows. Excel is super powerful in this. It has the built-in functions for both internal rate of return and net present value, and you can run side-by-side comparisons. It's just a very, very useful tool in finance. Excel is a great, great Microsoft tool that you all have access to. And personally, I would definitely trust Excel over any kind of calculator you might find online. Excel's way more accurate, and it can get it down to very far decimal points. So use Excel. Use Excel. It's your friend. Okay, we survived the last chapter of this book, of this course, which is amazing. No, I'm kidding. We all did very well. I take this chapter with a grain of salt because as you move forward with your degree program, you might be faced with these type of decisions. And in fact, you might be faced with these type of decisions in business or even in your personal lives. So take it with a grain of salt, but at the same time, these are great concepts to know because it might become helpful at some point in the future. So way of thinking about all of this complexity, right? If you are on the bachelor's degree side of things and you're in business, you'll probably take a finance course, a business finance course. When you take that business finance course, you will see the stuff again. Absolutely. So just knowing that's kind of important. Yeah. So just something to think about. That's how it's all related. As a reminder for this week, we have the discussion board related to the conversation we just went through. And we have the quiz related to this. Next week, we will talk briefly about the final part about QuickBooks, which requires a report, a written report, which I'm going to briefly open here just to kind of show you what it looks like. With this written report, a couple of pages, very straightforward. You're going to be identifying all 10 items in your written report. You'll have an introduction section, an overview, practical experience, key functions and tools, challenges faced, benefits and advantages to the software, any type of example or case study, future application, conclusion section, and then your references. It's not terribly long, this report. It's 800 to 1,000 words in length. It's a couple pages, really. APA formatting with citations and references, of course. Leland, I know you have already begun working on this. Do you have any words of advice for your classmates?
Oh, yeah, I would just say use the online videos as a reference to look at like QuickBooks online tips and tricks and QuickBooks Essential Training, Online Essential. You just go back and look at the videos and it helps you get some of the information you need to do the summary report.
Excellent.
Make it a lot easier. Yeah. Instead of looking
Excellent
over
advice.
Yeah.
Thank you, Leland. I appreciate you chiming in on the help your class out. But that's where we're heading. So, and as a reminder, if you do have past due work, please make sure you do all of that because we're reaching the end of this course, and I don't want to see anyone not do well because they decided not to do stuff. So remember, if you don't do the work, you're only hurting yourself. So, are there any comments, questions, or concerns that I can help to address at this time? Are we all doing okay?
I do have a question, but it's not
Yeah.
about the report. It's just about the final. I can't remember if you said, is it going to be on all the chapters or just the second half of the stuff we covered?
Just the second half.
Great. Okay. All right. I'm good now.
Cool. Yeah, and also we will probably have a brief session on the final exam as well, which we'll either do next week or the following week. But yeah, either way, yeah, we'll have a brief session on that.
All right. Thank you.
Cool. Yeah, my pleasure. Are there any other comments, questions, or concerns? We all good? Okay,
I'm
awesome.
good.
Great. Well, thank you all so very much for your time today. I sincerely appreciate all of you and your effort, especially over the past few weeks since we've been doing this a little bit more at a distance, if you will. But again, I appreciate all of you and your effort. Let's keep up the positive momentum. Let's finish this course strong. If you need anything in the meantime, you can email me or you can send me a message. I'll be back in the United States next week. So after that point, you can even call me if you need to. But I sincerely appreciate all of you. And I hope you have a wonderful rest of your night. Thank you so much.
Thank you,
Take care.
Professor. See you next week.
Thanks so much.
Thank you, Professor. Thanks so much.
Hey, my pleasure. Take care. Catch you later. Bye-bye.